Hi, everybody. Okay, I want to go ahead and go through these slides for Chapter 17, catch us up a little bit here. So you can see these slides are posted there under Chapter 17, and I'm going to go ahead and go through those. So let's put us back into slideshow mode here so we get the full image on the screen, and let's start to take a look at the information here from Chapter 17 dealing with investments. Okay, so jumping around a little bit in that we have had some discussion about liabilities. Then we came back and talked about stockholders' equity. Now we're going back to the asset side of the balance sheet and talking about investments here as we head into our midterm. Okay, so what we're going to be looking at are investments, and we're going to be looking at investments in both debt and investment in equity securities. We're not going to get into consolidations in this class. That's a different class where you completely focus on consolidation, but we'll understand how if an entity holds certain investments in equity securities, how we will use something called fair market method, and then we're going to go into the equity method, and then when we hold more than 50% of the stock of a company, we would consolidate, and we'll understand that, but we're not going to go through the actual consolidation process here. Okay, so that's our main focus for this Chapter 17. Okay, now when individuals invest, companies invest, maybe you're looking for dividends to pay out. Typically, investors who maybe are moving towards the end of their investment careers, for lack of more harsh way of putting it, the end of the days for them, maybe they want a dividend stock. If you have a younger investor or a company who's looking for a growth opportunity, they're maybe looking for a growth stock. Okay, that tends to be more the focus on stocks. We're going to talk about debt securities first, and we'll get more into investment securities later. Now, when we look at the two types of securities, okay, we can have basically two types. One is if we plan to, no plan to sell, we'll carry at amortized cost. That's for our debt securities. If we're planning to sell, it makes more sense to carry that at fair value. With our equity securities, we will carry those at fair value on our balance sheet unless we go past the threshold, which is if we hold more than 20% or more of the stock, then we go into something called the equity method, and we'll talk more about that. Okay, so as you start to take a look, if we're talking about debt securities, okay, so let's just start with the debt securities. Various types of debt securities, you know, they list out these different ones here. We're not talking about any of these government securities. We're really talking about corporate bonds here being held as an investment, and we're not really going to be getting into the accounting for conversion from the standpoint of a investor. We've already talked about it from the standpoint of the company that would issuing that debt. Okay, so again, we are an investor. We're buying these securities, right? And so when we buy these securities, we have one of three categories: held to maturity, trading, or available for sale. And depending which category this debt security falls in will determine our accounting. Okay, so at a high level, as you start to look at the different categories here, okay, and let's just start with held to maturity. That's the first one listed here. Okay, when we carry security held to maturity, we will carry it at amortized cost, which means on the balance sheet it will be reported at face plus any premium, or face minus the discount. Amortized cost, again, this is the investor's accounting, right? So what happens? There are no unrealized holding gains and losses. We're not going to have the situation where we compare to fair market value. It is not considered in these calculations here for security that's held to maturity. And so our income effect will simply be the amortization of any discounted premium plus the cash interest. So we're just going to have interest revenue coming in from these, okay? If we are talking about trading security means that you are actively trading that security maybe on a daily basis, but the intent is that you will hold this, you will not hold this to maturity. You will likely be trading it somewhere in the short term. If that's the case, on the balance sheet, fair value, income statement, we will recognize changes in fair value on the income statement. It will be recognized in income in any period. And of course, we will also have interest revenue. And of course, in all three categories, okay, once you actually sell that security, you would record any gains and losses on the actual sale, assuming you sold it before maturity, okay? And then finally, we have available for sale. So what happens here? Well, if we don't have a security in the held to maturity because we can't say that we have the positive intent and ability to hold it to maturity, then and we can't positively say that it belongs in the trading security because we're not sure if we're going to be trading it on a day-to-day basis, or we may trade that in the short term. Then they have a third category called available for sale, okay? And with available for sale, you're still going to carry it on fair market value on the balance sheet, but now as you hold that security, any unrealized holding gains and losses from the change in fair value do not go to the income statement. So notice fair value is the same on the balance sheet. Here, we're going to do what? We're going to go ahead and report gains and losses in the income statement. If it's a trading security, if it's available for sale, then we will include that in comprehensive income. We will report that gain or loss on our statement of comprehensive income, and then we will call out our accumulated other comprehensive income on the balance sheet. So a different treatment there for these available for sale. And again, we still earn the interest on all of these, and as part of our accounting for our income on this, and gains and losses from the sale. Okay, all right, now that's just a high-level overview. Let's just go ahead and start to take a look at each one of these. And again, in order to be considered held to maturity, we have to have the positive intent and ability to hold the security to maturity. And when we talk about auditing, sometimes we say, well, how do we know if they have the intent to hold something to security? Well, we would actually ask management to put in writing to us in a management representation that they intend to hold that to maturity, and then we would be looking at their financial condition to see if they have the ability. So the entity, of course, would have to figure this out for themselves and convince their auditors that it's the case that they have the positive intent and ability to hold a security to maturity. If that's the case, balance sheet, amortized cost, okay? And then what? Then we will count for our interest earnings using the effective interest method. So all that's happening, and we talked in chapter 14 about the effective interest for debt. Now we're on the other side of the table. Now we're the investor that's holding that security, okay? So notice we have what? We have a $100,000 8% bond, and we purchase that and we pay $92,278, meaning that we purchased that security for less than face. We purchased it at a discount because it is trying to yield 10% higher than the stated rate of interest, right? And so that security issues at a discount. Now, when we were on the debt side of the equation, the entity issuing the bond, we sat there and said, well, we have to show the discount, etc. When you're on the investing side, what you do is you simply put down that investment at what you paid for it. So since they paid $92,278, they will credit cash, they will debit and report on their balance sheet immediately upon purchasing this debt investment $92,278. Okay, now since we're carrying this at amortized cost, then we're going to have to figure out how we will amortize the discount. And as you know, as we amortize the discount, what? The carrying value of the bond goes up. So what's going to happen is we amortize that discount. We're going to see the carrying value go up. The difference between the cash interest and the effective interest will be the amount of that amortization of that discount. Okay, so they start to show you some calculations here, and basically they're saying, look, this bond is going to pay us what, $4,000 cash every 6 months. It's a semi-annual bond. Every 6 months it's going to pay us $4,000 cash. That's not going to change. Okay, but we're going to have to amortize that discount, and the way we'll amortize the discount is by multiplying the bond times the effective market rate of interest of 0.10 and semi-annual. Of course, we have to multiply that by 1/2, 6/12, whatever. And that gives us what? Actual interest revenue of 4,614. The difference between our cash interest and our effective interest is the amortization of the discount here. And so the carrying value for the next 6 months, of course, would be the amortization of the discount added to the previous carrying value there. And that gives us that new carrying value of $92,892. And that's how we'll calculate our interest for the next 6-month period. Okay. But before we get to that, let's just go ahead and take a look at the journal entry for the first 6 months. And we go ahead using those figures that we just calculated on the previous page. Of course, we'll always debit cash. Okay, we'll always debit cash for $4,000. That's when we get our cash interest on that. We debit the investment account because we're amortizing the discount. As you amortize the discount, the carrying value comes up. And then we credit interest revenue for the sum of the cash interest plus the amortization of the discount. Remember, when this bond matures, we're going to get the full $100,000 face. So our interest revenue, as we move closer to the day when we mature at the full $100,000, is being increased by the amortization of the discount. This is, of course, a discount bond. Okay? All right, good. Then we come over and they show us the journal entry here for the next 6 months. And let's just go ahead and practice a little bit with the calculations. So what happens? We went ahead and that's what we did July 1st. We're now at the end of the year, December 31st, and they're going to pay that first interest payment of 2020. They'll pay that in January. Okay, so we're going to have to set up the interest receivable for the cash interest that we'll be getting the next day, January 1st, but we have to amortize the discount again. So we're going to pick up this $92,892, right? We're going to multiply that by what? By the yield, the effective interest of 0.10. And then, of course, we always have to remember to multiply that by 1/2, or you could multiply the whole thing by 0.05, whatever. That gives me 4644.6. Okay. The difference between 4644.6 and 4,000 is what? $644.60. Okay, the book decided that it was okay to round that to 645. All right, so they go ahead and they debit the investment for 645. That, of course, will bring it up to this next carrying value for the next 6 months, $93,537. And of course, as we saw for the July payment, our interest revenue is the sum of we haven't received the cash yet because we're going to get it the next day, but the sum of what is going to be my cash interest plus the amortization of the discount. Okay? All right, good. Now you come over, and on our balance sheet, we are, of course, reporting the interest receivable, the new carrying value of the bond after we've amortized the discount. That's that $93,537 right there. Okay. Even though it says July 1st, since we made this entry on December 31st, it came up that 645. So we would report that at December 31st on the balance sheet. Okay. And then, of course, our interest revenue is going to be the sum of the interest revenue that we calculated for the July payment and then the end of the year. And, of course, that'll turn into a cash payment on January 1st. Okay, that we'll get the $4,000 cash, but that interest revenue would have been recognized in December. It covers a period from July 1st of 2019 to December 31st of 2019. That's 6 months. All right. Okay, good. Now, when we go to sell the security, and we're basically going to have to compare whatever we sold it for versus its carrying value at the date of sale, and that difference will be our gain or loss on the sale. Okay. Now, it is important, be careful, that you go ahead and you amortize the any amount of unamortized discount at the time that you are going to sell it, because that's going to determine the carrying value that you will compare to the cash that you will sell it for, and that difference will be the gain or loss. Okay, so they go ahead and they tell us that they're going to sell this bond on November 1st, 2023. The discount amortization from July 1st, 2023, which would have been the last interest payment date in 2023, to November 1st, 2023 is $635. Okay, so that's 4/6 times the $952,000, which would have been the total interest for that entire $952,952, which would have been the total interest for that entire 6 months. So when we do that, we basically have to debit the investment, accrue that, amortize that discount, bringing up the carrying value, and take the interest revenue for that portion of our interest revenue for that portion of the amortized discount. So you always got to catch yourself up at that point in time to amortize the discount. Okay, so once you do that, and let's see, I guess it would be helpful here to just let's look at the table that we had earlier. Oh, okay, they don't take me up to 2023, so I guess I just have to take their word for it. Let's see. Oh, here we go. Okay, 2023. So we're what? We were here at the end of July, and then they're basically going to sell that bond in November. So it's all of July, all of August, all of September, all of October, and they sell the bond November 1st. So that's 4 months, right? Don't count November because it's November 1st. So it's the 4 months that they're going to go ahead and amortize that discount for. So you see that at July 1st, it was 99048. Now we can go back, and I think that's a little clearer to you now. So you've got that 99048, and then you have what? You have this 635 of amortized discount, bringing the carrying value up to 99683. Okay, now they told us that we sold the bond at 99 3/4. So 99 3/4. Okay, thanks a lot, book, for not showing that calculation. Point 9975, I guess, times the $1 million face on the bond is this 997,500. Oops, except, okay, let's just do that again, guys. Okay, so I'm taking 0.9975, and I said times the million, times the $100,000 face on that bond. 100,000 face, they should have showed us this calculation, times 0.9975 gives me 99,750. That's what they're selling the bond for. That's where that stupid number came from. Okay, and then remember, at July 1st it was 99,048. We amortized the discount. That for that 6 months, that brings the what? That brings the, not 6 months, but 4 months, and we saw the calculation for the 4 months there. They took what would have been the full amount of discount amortization for that 6 month period, and then just multiplied it by 4/6. Okay, and then we come over and we get this 635. We add that to the carrying value, previous carrying value. that means that they have a gain of $67 on the sale of this bond. Okay, so we go ahead and we debit cash, and the cash that we're going to get is going to be not only the sales price of the bond of $99,750, but also the what? The interest that has accrued from July 1st to November 1st when we're selling this bond. Look, you're not going to sell a bond to somebody and not consider the cash that you're supposed to get, the cash interest or the interest that you've earned for that 4-month period. If that's the case and you're giving up that interest, then you're selling that bond for a different price than $99,750, right? So we go ahead and we add that 2,667 in there, and that's where they get that 102,417. So it's what you sold the bond for plus the interest that you would have earned between July 1st and November 1st. You're going to collect that cash too from the purchaser of that bond, right? And then we have the interest revenue there, which is that 2,667 that I just calculated. Notice our total interest revenue is the portion of cash that we earned for that period plus the amount of the discount amortization that we took. We just did in a separate journal entry there. And then you would go ahead and credit the investment for the 99,683, which would have been its carrying value after you had amortized that discount from the previous 6 months. Okay. Okay, good. Okay, so, not too difficult. I mean, a little bit multi-layered steps that you have to go through. I think the biggest thing when you deal with the ultimate sale of the bond, never ever forget that you have to do what? You have to calculate any interest revenue that has accrued since the date of the last interest payment date. Catch that up, which includes amortizing, in this case, a discount. If it was a premium, you would amortize the premium up to date, and then go ahead and calculate your gain or loss on the sale, as we did here, and then go ahead and record that journal entry. And I forgot to click one more time so we get the gain on there. Okay. Okay, good, excellent. Let's go ahead then and let's move ourselves on to what happens if we are dealing with an available for sale security. Okay, so now we aren't carrying this as a held to maturity. We're not carrying it as a trading. So now we're going to carry it as available for sale. Now, if that's the case, calculation of the interest revenue that we've been looking at is not going to change. That won't change. We'll amortize, I think in this example, it's the premium. We'll amortize the premium, or as we saw in the previous example, the discount. We'll go ahead and do that. We'll go ahead and calculate our interest revenue. We'll calculate the new carrying value of the bond, using the effective interest method, calculate our interest revenue, and our amortization premium or discount based on that new carrying amount. All that part's the same. What's going to change is we're going to also have to add on to all that now a comparison of the carrying value of the bond, which is what? Face minus discount or face plus premium. Whatever that carrying value is, the bond at the end of the reporting period, typically the end of the year, we're going to compare that to the fair value. And that difference now is not going to hit we didn't do that in the case of the held to maturity until we actually sold the bond. We're going to do this year to year as we hold the bond. That's going to generate an unrealized holding gain or loss because we haven't sold the bond yet. So we're still holding that bond. We haven't realized that gain or loss yet. And that unrealized holding gain or loss will be reported as part of my comprehensive income, the amount that has been calculated for the period, and then any amount that has been accumulated in my accumulated other comprehensive income is part of my stockholders' equity. Okay, so we're kind of combining really two thoughts here. How do you account for comprehensive income, and how do you but in the focus of dealing with an available for sale investment security. Okay, so let's just go ahead And let's take a look. And you've got this company here, and they buy this security, this bond, whatever, and they buy it for $108,111. So they've got an $8,111 premium here. Again, we don't call out premium and discount for the investments. We just lump it all into the investment account. It's a $100,000 bond. 10% is the coupon face stated rate, and the effective rate is 8%. Okay, so let's just go ahead and let's take a look, and they show us the calculations here. Again, the $5,000 cash interest on this, which is based on the stated coupon contract rate of that bond, will not change. That's the $5,000. It's going to get paid every 6 months. Okay, for the first 6 months, January 1st to July 1st, we are going to calculate interest by taking that initial carrying amount that we set up that investment for, multiplying it by the effective rate of interest times the semi-annual half-year 6/12 period. Mechanically, same thing we did a minute ago for the held-to-maturity security, right? You compare the difference between the effective interest and the cash interest. That difference, because this is a premium bond, becomes my premium amortization. Okay, so what happens? I go ahead, and of course, with a premium bond, we are going to have the carrying value come down towards face. So we will do what? We will reduce the carrying amount by that amount of now premium amortization, and so on. So it's the same thing we did, but it's now, instead of being a discount, it's a premium. So now the premium amortization, rather than being added like we do with the discount, we subtract it when it's a premium. So if you're having deja vu, yeah, that's chapter 14, but we were at that point looking at it from the standpoint of the borrower, the bond issuer. Now we're looking at the standpoint from the bondholder, the investor, right? Okay, so once we get that, we make our journal entry, which is to debit the cash. Okay, credit the investment as we bring it down towards face, credit the interest revenue that we had calculated here a minute ago. Okay, now you come over to the next page, and they want us to calculate the entry for the interest revenue for the second 6 months right here. Okay, so the carrying amount of that bond was what? It was 107,435. We multiply 107,435 times what? Times 0.08 effective, the yield interest, times the 1/2. Okay, 6/12, 1/2 is the same thing. And this time I get 4,297. I guess it's right there, John, right? I'm just showing you where they got that as my interest revenue for that next 6 months, which will be paid on January 1st of 2020. But I'm doing this at December 31st because I have to accrue my interest for the 6 months that is ended December 31st, 2019, right? So I go ahead, I calculate that, okay? The difference between the 5,000 and what? And the 4,297 is this 703. And I'm going to do what? Again, because it's a premium, I'm going to subtract it from the previous carrying value to get the new carrying value. Okay, so now we can go ahead, and again, we can't debit cash yet because that cash isn't going to come to that next day. We go ahead, we credit the investment because we're bringing it down, right? This is an asset, right? So we want to bring it down. The carrying value is getting closer and closer to the 100,000 that it'll mature at. And we calculate our interest revenue as the difference between the 5,000 and the amount of interest that we calculated right there. Okay. Actually, our interest revenue is that number. It's not the difference. The difference is the premium amortization. There's our interest revenue right there. Okay. Okay, good. And I think there's some rounding in there, guys, so don't freak out if you don't get the exact numbers. The book is pretty generous in its rounding. They don't want to deal with cents, I guess. Okay, now, finally, we go ahead and they tell us that the fair value, okay, now this is So all we had difference between the held to maturity example and the held for available for sale example so far was that the held to maturity was a discount. This one's a premium. So in mirror image of the two, but same exact mechanics, right? Okay, but now because this is a held to maturity security, we have to do a fair value adjustment. So we're going to have to look at this security and we're going to have to say, well, what is the difference between the carrying value at the end of the period? And the carrying value was this 106,732, right? After we amortize that discount for the last 6 months of the year from July 1st, 2019 to December 31st, 2019, right? Carrying value December 31st, 2019 is 106,732, okay? And the fair market value, which we would have some method of figuring out what the fair market value of this bond was. We won't cover that in this class. We would just give you the fair market value, right, in the problem setting, okay? And so that difference is what looks like a loss to me, right? Because the fair value is below the carrying value, okay? So I'm going to have to debit, and they say unrealized holding gain or loss, which is irritating. It's a loss, okay? Just call it such. It's a loss. Unrealized holding gain or loss. I see why they're saying gain or loss, but by the time we get to the financial reporting, we wouldn't say unrealized holding gain or loss like we don't know what it is. When we finally put it on our income statement, we'd call it a loss. So what they're really giving you here is more the GL account name, the T account name. And then, because we may have several securities and some may gain, some may lose. But at the end of the day, if you end up with a debit balance in there, that's a loss. And when you prepare your income statement or your statement of comprehensive income, you're not going to sit there, unrealized holding gain or loss. I don't know. You figure it out. We would call it out for what it is. It's either a gain or a loss, but we'll call it one or the other. This is more showing you the GL account title, right? Because if you have several securities, some could go up, some could go down, and you may end up with a debit or credit balance in there, okay? And then we're going to bring down the security by crediting it. So now the amount that's reported on the balance sheet is going to be the fair value adjustment. Now, we'll continue to amortize our discount and our premium based on this carrying amount, and then we'll continue to calculate unrealized holding gains and losses by comparing whatever the carrying value is based on this versus what the previous carrying value was. Okay, so we come over and let's just go ahead and see how we would analyze this using a portfolio approach. Okay, so in this example, they have two securities, two securities, okay, and they determined that they need a loss amount of 9,537, and they're going to have to write their securities down by that much. Okay, so since they know they need this fair value adjustment of 9,537, okay, they go ahead and based on the entire portfolio, okay, they debit the 9,537 for the, in this case now it's basically going to be reported on the statement of comprehensive income as a loss, and then they credit this fair value adjustment, which will bring the total of all their investment securities now down 9,537. You know, if you have several investments, you're not going to call every investment out on the balance sheet. So you would say, you know, investments held as available for sale, and then you'd have the fair value adjustment. So the entire portfolio is now brought down by this 9,537. Okay. Now, something that they sort of leave out here, and I think leads to some confusion for students. Okay, this account, and again, it would be called out as a loss, will get reported on the statement of comprehensive income. Okay, so comprehensive income is net income, and it's going to be adjusted by any other comprehensive income items. And there are several other comprehensive income items, and unrealized gain or loss on available for sale securities is one of the items that would be inclusive in our other comprehensive income for the year. Okay, so this is our unrealized gain or loss. Okay, I'm not liking that T account. Let's do that again. This is our unrealized gain or loss T account. Okay, and let's say we evaluated each of these securities during the year. And so, you know, we did that as we did them one at a time the way we saw. So there's a 10,063 for, oops, wrong side, 10,063 for the gain. And this 19,600 for the loss. Difference is what? Is 9,537. Okay, so the balance in this account now is what? A debit balance of 9,537. I prepare, that's a good place to write this. I prepare my statement of comprehensive income. Okay, and my statement of comprehensive income is a combination of my income statement and my other comprehensive income. Okay, and you could do it with one statement or two statements. I'm assuming a one statement approach here. Okay, so statement of comprehensive income. Just rewriting the word income here. And so what happens is, like you would in any income statement, you'd have revenue minus expenses equals what? Net income. Okay, I'm not writing revenues minus expenses here. I'm showing my net income, whatever that is. And then you would continue on and you would call out other comprehensive income. Okay, and my other comprehensive income is going to include unrealized. There could be several factors that contribute to other comprehensive income. Pension adjustments, if you have effective cash flow hedge, there's a bunch of different things. We're not going to get into all that here. But you have an unrealized, and this is an unrealized loss because that's a debit balance up there on available for sale security, AFS security. And you don't have to call it out by category, but you know, I'm going to just take the approach here in which I will call out my other comprehensive income by specific items, and in this example, we will have the one anyway, and that's 9,527, and that would basically be a loss that would subtract from my net income or add to my net loss. And then that would be my comprehensive income. That's my comprehensive income, and whatever the sum, I put a number there. Let's say this was, let's just say this was $1,000. Say it was $10,000 net income. So my comprehensive income would be that $10,000 of net income, right, which is my revenue minus my expenses, just like you've learned for years now, minus $9,527 for my unrealized loss. And so I would report comprehensive income of $473. So comprehensive income is net income plus other comprehensive income. Again, there are several things that can contribute to other comprehensive income, and an adjustment for unrealized loss in this case, or gain on an available for sale security, would be one of those. And when we consider that, we get the comprehensive income. Net income plus other comprehensive income is our comprehensive income. Okay, now after we've done this reporting on our income statement, of course, then for our net income, we would do what? We would debit our revenues, credit our expenses. The difference would be what? $10,000. And since this was a positive net income, we'd have an extra what? $10,000 of revenue. So when we perform our closing entry, we eventually would have to do what? Debit income summary for $10,000 and credit retained earnings, right? For $10,000. That's for our what? Our net income, okay? Then what? For our other comprehensive income, we don't put that 957 in there. What we would do is, since we have this 9527, and because this is a debit balance, we would credit unrealized gain or loss 9527. That zeroes it out. It's like an income statement. It's like like an income account, like a revenue or expense account. You close it out to zero at the end of the year, and then you go ahead, and I'm just running out of places to write here, you would credit accumulated OCI. And since you went ahead and credited that there, I think I said you'd credit it, you would debit 9527 into your accumulated other comprehensive income. That gets reported on what? That gets reported, and I don't know where I'm getting the 27, guys, I apologize. It's 9537, which I guess makes this what? 474, I guess. Okay, and is that right? I'm never good at that kind of thing on the fly. 10,000 minus 9537 gives me what? 463 is what my comprehensive income would be here, 463. And so I'm going to do what? Credit this 9537, John. That closes that out to zero, right? And then I would debit my accumulated other comprehensive income 9537. So accumulated other comprehensive income is sort of like what? Like the retained earnings for our other comprehensive income items. Okay, so we close those out to a different part of equity, not retained earnings. All right. Okay, good. Now that's the portfolio approach. Now we've dealt with what? So we've dealt with the interest earnings from this. We have dealt with what? The fair value adjustment for this now at the end of the year, seeing that for an available for sale security, that fair value adjustment gets deposited into my other comprehensive income and ultimately into my accumulated other comprehensive income, right? Okay, then I go ahead and I sell the security, okay? And when I sell the security, I'm simply going to compare the selling price to the carrying value at the point in time of sale. So they're telling me, hey, you got this investment left now, okay, these Watson bonds, and you're carrying those at 94,214. You sell them for 90,000, so you now have what? A loss of 4,214. Okay, so when you go ahead and you calculate that, you take the investment off the books, of course, and recognize the loss. So 3 different things affecting, let's call it comprehensive income, right? The regular income, right? My net income is being affected by the interest earnings and what? And this actual sale of the security. And this is a loss on the sale of the security. That's on the income statement. Then what? On my comprehensive income statement, which is going to include net income and other comprehensive income, we have the other comprehensive income, which is the comparison between the fair value of the security and its carrying amount from year to year. Okay? All right, good. Now, notice then that you look and we sold the thing had a previous balance of 9,357, and we've got rid of the security that was constituting that 4,537 portion. So now we're only left with needing 5,000 in the fair value adjustment. So that's the case. We have too much in there. So what do? Now we're going to go ahead and make the adjustment to bring it down so that there's only 5,000. We debit fair value adjustment. That brings the carrying amounts up. And we credit unrealized holding gain. That unrealized holding gain now is going to be closed out to the accumulated other comprehensive income, right? So now the AOCI, accumulated other comprehensive income, had that balance, and I'm not going to put all the detail, but it did have I'll write it on the debit side though, so it's clear that it had a debit balance in there of 9,537, right? And then what? We say, well, we have too much. We only need 5,000. So we go ahead and debit the fair value adjustment. That brings the carrying value of that of all of our securities up the 4,537, so that there's only a fair value adjustment of 5,000 now, and the accumulated other comprehensive income account has to match. So we're going to go ahead and debit the unrealized gain or loss, and we're going to debit that for 4,537. That's 4,537. Sorry guys, I know that's hard to read over that. 4,537. That's 4,537. That's a debit. And then we credit what? We credit accumulated other comprehensive income, right? Because that's the closing entry for that, 4,537. And when we do, and we credit that over there, 4,537, now the balance is what? The balance is 5,000, which is what we want. We have our investment, which has gone up 5,000. We have our what? Our stockholders' equity, because that was a debit, it has come up by not 5,000, but by 4,537. The securities come up by that through this debit, and then we've gone ahead and credited ultimately the accumulated OCI. Okay, good. Now, this number, of course, is going to be reported before we do our closing entry on our statement of comprehensive income. So they show you the income statement, okay? But they should also, in my opinion, show you what? Accumulated, not accumulated, but the OCI for the year. OCI for the year was that what? 4,537. Okay, so again, our comprehensive income statement, okay, if this was statement of comprehensive income, which you're either going to have to have comprehensive income, you're either going to have a one statement approach in which you put it all on one statement, your comprehensive income, or you could have two statements where you have your income statement and then you continue on with your comprehensive other comprehensive statement, and you could break them into two, but eventually you're going to have to show this is my total comprehensive income. Okay, so I'm just assuming a one statement approach. You'd report that what did we call it on the previous slide? We called it unrealized holding gain right there. Okay, and then notice they did show me my accumulated other comprehensive income there. Very good, book. They did what? They showed me the 5,000, which, yeah, okay, we knew it was 5,000 because there it was right there. Okay. Okay, so that's my available for sale security. Okay, so what we're going to do at this point then is go ahead and take a look at what happens if we have a trading security. Okay, so I'm going to go ahead and give you a second to take a quick break so you can go ahead and hit pause, and we'll come back and we'll pick this up. Okay. Okay, guys, let's go ahead and continue on with our discussion of debt securities. So we had held to maturity, we had available for sale, now we're going to trading. And as we go through this, you may have a little trouble distinguishing, well, what's the difference between what we said about available for sale and trading? Balance sheet, no difference. We're going to carry the securities at fair value. The difference is that while we'll still calculate the revenue, interest revenue, and we'll still report that on the income statement, cash plus the amount of the discount amortization, or cash minus the premium amortization, just like we were doing for the available for sale securities. Now, when we figure out what the adjustment is for unrealized holding gains and losses, only difference, it's going to get reported on the income statement, and we don't have to worry about reporting anything in other comprehensive income if it is a trading security. Okay, so with a trading security, the idea is that we're probably trading these on an active basis, and so it makes more sense to run it straight through our regular income as opposed to our other comprehensive income. Okay, all right, good. So let's go ahead and take a look. I find my clicker here and see the example now where we have the securities that are trading securities, and we've determined that we need a valuation allowance of 3,750, and so we're going to have to debit the fair value adjustment by 3,750, and we're going to take this 3,750 gain here. And the only difference, instead of it being part of other comprehensive income, it's going to be part of our net income. Okay, so when you see the journal entry, you're saying, well, John, that looks just like what we did for the available for sale security. And you're right. The only difference is now that's reported on the income statement instead of the other comprehensive income statement. And of course, that would get closed into retained earnings as opposed to accumulated other comprehensive income. Okay, all right, I'm going to let you look at this example on your own. It is more comprehensive. It is very similar to what we have seen on the available for sale security. Only difference is, again, these unrealized holding, in this case loss, goes to the income statement, not other comprehensive income. Okay. All right, good. So let's move on from that, and let's start to talk about now our investment in equity securities, stock. Okay, so what happens when we invest in stock? Well, now we're going to see that we're not going to have held to maturity, obviously. If it's a stock, there is no maturity on it. And we're going to treat everything as how we treat the trading securities. So for debt securities. So there's no held in maturity. Obviously, there can't be maturity for a stock, but there's no, probably more importantly, available for sale category. So there's no other comprehensive income. Everything runs through our net income in these calculations. Now, what constitutes how we're going to account for this, though, is not whether we've put it into a category, but how much of the stock do we own, okay? If we own less than 20% of an entity stock, and let me just go ahead and show you the visual for that, okay? So again, everything is going to be run through the income statement, and the price of the security will not only include the actual purchase price, but any commissions that are paid, okay, to acquire the stock. That's part, just like we've said for any asset, whatever you pay to acquire that asset is part of the cost of that asset, right? So if you had to pay broker's fees, that's part of what you'll debit to the investment account, credit the cash. Partially, most of the cash is going to go for the price of the securities, some's going to go for broker fees, right? Okay. But then what I'm trying to get to here, the most important thing, is how we should treat the security, not based on some category that we put it in, but based on these guidelines that say, look, if you own less than 20% of the stock, you do not exert significant influence, and so you're going to use the fair value method. Once you cross that threshold into 20%, now you're going to use the equity method to account for that security, and you'll account for it as an investment. And we're going to see that we're going to be taking shares of the entity's income and adding that to our net income. And it's pretty easy, the calculation there. When you cross the line from 50% to more than 50%, right? 50.0001, 51%, we'll say, to make that visual a little easier, then you will consolidate. Now, that's all you need to know about consolidation in here as to when you will consolidate. We will cover consolidation more in another class, and that process involves literally eliminating the investment account that we'll be keeping track of here using the equity method. You actually eliminate that account when you get into consolidation. But we're not going to cover consolidation. Just know that if you own more than 50% of the stock, the method you use is consolidation at that point, okay? And so they go ahead and they articulate that here on the next slide. And we're going to see how we're going to account using these various methods, the fair value method, the equity method. And again, for consolidation, we're not going to really have any numbers. Just remember, well, the only number is 50% or more than 50%, then you consolidate, okay? All right, good. So let's just go ahead and we're less than 20%. Again, as soon as you cross that 20% threshold, then you use the equity. So assuming we're 19.9999%, okay, less than 20%. And again, guys, on questions, I don't sit there and get into the nonsense of, well, it's 21%. What should we do? Okay, when I give you a question, it's going to be clear that you're well past that 20% threshold. I might have you in 30% ownership of the stock, okay? But if you acquire 20% interest, then you move to the equity method, okay? Here, for all of these investments listed, we are less than 20%. So we have to mark this stock to fair value. And so we see that the total cost is $718,550, which includes broker fees and stuff, right? And then when one of these stocks or all of them, whatever, pay out a dividend, our revenue is the dividend. They pay us a dividend, we debit cash, we credit dividend revenue. Okay, now we've got to deal with the fair value component, and so we have the cost. And the difference between the cost and the fair value is this $35,550. So we mark the stock to the fair value under the fair value method, again, using the fair value method because we own less than 20% of the stock. And so we go ahead, we debit the unrealized holding loss. That's reported on the income statement. There is no other comprehensive income impact here, and we credit the fair value adjustment. Okay, and then later on, if we sell the stock, okay, and notice they sold the stock for $287, it was being carried at its cost of $259,700. Difference is going to be the gain on the sale of the stock, $27,520, and so we go ahead and we calculate and we record that gain. Again, that is going to affect our net income. After we've sold that stock, of course, then what? Then we need to go ahead and do our fair value adjustment. That stock is out of our portfolio now, the one we just sold. Maybe we add some others, whatever. We had $35,550. Now we need a fair value adjustment of $99,800. That's going to be what? That is the debit now that we're going to put for our adjustment, and now we credit the gain because it's come up to $99,800, and that is going to be reported as income on our income statement. Again, that's net income. That's part of net income on the income statement. Okay, all right, good. Now, what happens when we go past 20% and up to 50%, okay? Then we use the equity method. And equity method is pretty easy to use. I think you'll like the equity method, okay? So let's just go ahead and let's take a look. And we're going to see that we're going to increase the investment account and take income for our share of the investees' earnings, because now as you start to get closer to that 50%, past 20% towards 50%, or 20% or more towards 50%, now they tell us, well, you exert significant influence, so you should actually take as your investment income your share of the net income of the entity that you're holding that much stock in, because you exert significant influence. When a dividend is paid, that dividend is seen as a cash out of your investment. So you literally will debit cash for the amount of the dividend and credit the investment account for that amount of cash that you received. Okay, so let's just go ahead, and I know this is a little bit tough to see on your screen, so you might want to get a pull a little closer so you can take a look. Okay, so what happens? We buy the investment. No difference, okay, between the equity method and the fair value method, other than in the equity method example, we ended up acquiring, and they sat right on 20%, which I don't care for, but that's all right. I'd have you more than 20%, but they say that they got 20% of the stock. I guess they're trying to remind you of the threshold there. And so they say, hey, you know, you are now going to use the equity method here. They're assuming it was less than 20%. Okay. Then what? Then we come down. I'm going to get rid of that. It's kind of making things hard to see. I think highlighter is better for this. This sort of a table presentation. Okay. Then what? Then they tell us that there was $200,000 of income for the investee, and since we now have acquired 20% of that stock, look what we do. We increase the investment account by our share of the income of the entity, and we credit investment income. So the balance sheet goes up. The income statement goes up for our share of the investees' net income. Notice for what? For the fair value method, we didn't do anything, right? Okay. For the fair value method, you wait until you get a dividend. Okay. So they say, hey, 48,000 shares, $12 per share. I guess they like for us to, oh, I see. I apologize. Basically, they're saying, hey, there's been an increase in the fair value. Okay, so what happens? If there's an increase in fair value method, you're going to debit the fair value adjustment and take a gain for that. That's reported on the income statement. Equity method does nothing. Okay, now where I thought they were going with this. is right here. When there's a dividend that gets paid out, and it was $100,000 total, we own 20% of the stock, so we're going to get $20,000 of that if we were accounting for that. And of course, why would we if we were sitting there under the equity method? But I guess here they're going to say, well, you got 20,000 dividends and you're not using the equity method, you would take dividend revenue. In the case of the equity method, notice that we take 20% of that dividend. 100,000 times 20% is 20,000. Of course, we debit cash, but we credit the investment equity. So if you were sitting here and looking at, well, what's going on with the equity account right now for this, the investment account for this equity method, okay, here's my investment. And I brought in 480. Okay. I did what? I brought in my share of the net income, because the 480 is what I paid for it. I brought in my share of the net income, that's that 40,000. And then I did what? And then I just credited it for 20,000. Okay, so when I'm going to show you some questions when we look at the practice midterm, where I'm going to say what's happening with the equity account, and I'll expect you to be able to do that analysis. Whatever you originally paid, plus your share of any net income, minus your share of any dividends that were paid out, or, and this would of course be mutually exclusive here, if it had been a loss, then you take your share of the loss, and the loss would be, of course, credited to the investment account. Okay, and then again, there is no entry for changes in fair value under the equity method. The equity account is adjusted up and down by your share of the income, your share of the dividends, or if there's not income, your share of the loss. Okay, all right, good. Now, again, as we said, all we're going to say about consolidation here is that if you acquire more than 50% of the stock, you need to consolidate the financial statements, subject of another class. Okay? All right, guys. Good work. Be looking for that practice midterm, should be coming up. Okay, not practice midterm for chapter 17. Okay? All right. See you soon, guys.